Good morning, good afternoon, good evening. Welcome to the Value Creation Playbook channel. Today in episode 13, we talk of value creation strategies. In this episode, we'll focus on a moment where every private equity leader, founder, and CEO faces eventually preparing for an exit. Now, here's the key. The buyer isn't buying what you have built. They are buying what they believe you can become. And that belief, that future growth story, what separates a 7x multiple from a 10x and more. Multiple expansion doesn't just happen because you have a good year. It's a result of a deliberate engineered move over a 12 to 18 months runway. Today, in today's episode 13, I'll walk you through the playbook, creating the right valuation story, tailoring prep for strategic buyers versus IPO, cleaning up the balance sheet, and of course, at the end of the day, to remove the red flags and command a premium. Let's start by understanding the runway, which is essentially the market context. Believe you me, over the past 18 months, M&A has been choppy. Bain's 2024 global M&A report shows P-back exits down almost 20% year on year, with multiples compressed across sectors. That means you can't count on market momentum to lift your valuation. You have to create your own momentum. If you are a C-suite leader or a board member, you are fighting two battles at once, delivering this year's result while also positioning the business for a sale or IPO down the road. That's why I frame exit readiness around three priorities. One, build a valuation story that convinces buyer that they are buying growth, not cash flow. Two, tailor your preparation to the exit path, strategic buyer or an IPO. Three, clean up the balance sheet and governance so there are no valuation drags. And remember my previous episode on ESG. That's a nice segue into this entire story I'm talking about. Think of this as your 12 to 18 months exit runway, the steps that keep you in control of your multiple instead of leaving it to the market process. Let's talk of creating the valuation story. A high multiple is as much as a perception as it about the numbers. Remember, buyers pay up what they believe the growth story is, and you need to engineer that belief. Three levers really move the needle. Premiumization. Move your offering up market. Tiffany & Co. For example, repositioning it to boost margins and brand equity. Digitization. Embed tech into a model to scale faster and improve margins. Siemens Energy's digital twin technology is a great example. It just didn't improve efficiency, it differentiated them in the eyes of the buyer. ESG, as we had covered earlier in my previous episode, is a clear value add. Think of Schneider Electric, it boosted this appeals to sustainability, focused investors and customers. Your goal at the end of the day is to weave this into one cohesive narrative so the conversation shifts from what's your trailing EBITDA to how big could this be in 3 years. That's when multiples starts expanding. We touched upon this earlier. Now let's unpack this in this particular slide. Whom do you choose? A strategic buyer versus an IPO prep? The exit path you choose changes everything about how you prepare. If you're selling to a strategic buyer, they care about fit and synergy, how your assets accelerate their strategy, integration readiness, IP, customer contracts, market accesses matter. Microsoft's 69 billion acquisition of Activision Blizzard wasn't just about revenue. It was about controlling IP and winning in cloud gaming. On the other side, if you're going for an IPO, the focus shifts to governance, predictability, and transparency. Public market investors want sustainable growth, margin consistency, and a clear leadership position. Reddit's 2024 IPO shows how governance and investor relation discipline can be as critical as revenue. The trap many companies fall into: picking the exit route too late and trying to retrofit prep work. That's how you lose valuation points. Get this absolutely clear. It's one or the other, not a retrofit. Now, what changes in the approach? Let's make the contrast clear. For strategic buyers, show you can integrate smoothly, culturally, technically, operationally. Spotlight unique assets they can't replicate easily. Build your data room to highlight synergy potential. For IPO investors, on the other hand, deliver predictable quarterly results and guidance discipline. Lock in governance and compliance frameworks. Make it transparent, make it predictable. That's a good story about IPO. Prepare for analyst level scrutiny on every KPI that you have designed and reported. Think of Spotify's direct listing, all about transparency and user growth. Compare that to Salesforce buying Slack, all about integration and combined opportunity. When you choose early, you can shape the business story to an audience that matters and avoid the last minute scramble. Now, this is an interesting topic to talk about: cleaning up the balance sheet. A messy balance sheet, my friends, can kill confidence, not only in the CFO community, but it also trickles down to your overall stakeholders universe. It's just like selling a house with visible cracks in the foundation. The cleanup starts, and I say in three broad compartments. You eliminate non-core assets to sharpen your growth story. You resolve your liabilities, legal disputes, excess debt, and working capital issues. Third, audit quality, clean, unqualified audits from credible firms. Look at Tata Consumer Products. They sold non-core brands before acquiring in coffee and beverages, making the portfolio cleaner, capital allocation sharper, and the company more attractive to buyers. A streamlined balance sheet at the end of the day speeds up due diligence. That's one of the biggest stumbling blocks for any acquisition or any M&A activity. It removes negotiation friction and signals lower risk, all of which can lift your multiple. Now is a very interesting topic. It's all about governance. Governance is often ignored until something goes wrong. But at exit, it can be a quiet multiplier. That means adding independent director with relevant exit experience. It can also mean strengthening your compliance, ESG reporting, risk frameworks. And of course, ensuring transparent, consistent reporting to all stakeholders. And when I say stakeholders, it's the entire universe of any people on organization whom you're directly or indirectly touching. Before its 2023 IPO, Birkenstock overhauled its governance, adding seasoned board members and strengthening audit committees. They repositioned themselves as IPO ready despite decades as a family-run company. Good governance tells buyers and investors we are built to scale without chaos. That reassurance can justify an extra turn in valuation. Key takeaways? Here's the short version. Essentially, three key takeaways is what I would say. Your valuation story is currency. Numbers matter, but the narrative turn potential into premium. Exit path dictates prep. Strategic buyers and IPO investors want different things. And lastly, cleanup is non-negotiable. Balance sheet discipline and strong governance remove friction and reduce risks. Preparing for exit is like training for a triathlon. You can't focus on one leg and expect to win. It's the combination of performance, positioning, and discipline that drives multiples expansion. Whether you are handling the keys to a strategic buyer or ringing the opening bell, your multiple will reflect how well you have engineered both the story and the substance. Let's wrap this up. I hope you have enjoyed hearing me talk about how to get your valuations right, how to do the exits correct, and earning the multiple that you deserve. Thanks for being a part of this journey. Thanks for being a part of this today's episode. Look forward